So again, in line with my policy is trying to tell you up front what you will see in the real world, what you will not see in the real world. Everything we're going to talk about today, any large for-profit investor-owned system, Humana, Aetna, for example, they will all be users and take their corporate cost of capital very seriously, because there's billions of dollars in investment decisions being made. They will put a lot of effort into coming up with a good estimate of the corporate cost of capital, and they will use it in their financial decision making. Not-for-profit systems, you will see not as much effort put into them. There'll be more of a thumbnail sketch. I suspect most CFOs of Duke and UNC and other sort of academic medical centers have got corporate costs of capital in the back of their minds that are based on the cost of debt plus an estimate of what their return on equity capital is or should be. And then in small organizations, you won't see it used very much at all. So with that background, what are we talking about when we talk about the corporate cost of capital? Well, essentially, it's an input to the capital budgeting decision, because we want to make sure that over the long run, we select projects, programs that have got costs of capital that are less than the rates of return on those projects. Otherwise, we threaten the long-term financial viability of the organization. So what is the cost of capital? It's a blend of the different costs of permanent financing sources. And what do I mean by permanent?
You're using it for acquiring long-term assets?
Exactly. So we're talking about long-term assets. We're not talking about working capital. We're not talking about how we're going to pay next month's bills. We're talking about how are we going to finance new buildings and equipment, permanent long-term assets of the organization. We're going to use it as a benchmark rate of return so that when we decide, yes, we're going to build this new patient care tower, or yes, we're going to start a new division of our medical supply company, we're going to use it as a benchmark so that the cash flows, the rate of return on those investments have to be greater than the cost of capital. So there are several things that we have to talk about when we talk about the corporate cost of capital, which is what goes into the corporate cost of capital, how do we handle taxes in the case of for-profit, and historical versus marginal costs. So probably the easiest component of the corporate cost of capital to estimate is the component cost of debt. Because we see debt traded, we can see what the banks will be charging us in terms of interest rates if we go with them. And so typically what we'll do is we'll go to an investment banker if the bonds are used, and a commercial banker if we're going to use loans. And they will tell you what rates of interest they would charge for permanent or long-term debt, as it were. A second place to look is if you're UNC or Duke or a large system that's got debt that's out there, issued debt out there, you can look at the yield to maturity on those bonds. What does the yield to maturity on existing bonds tell you? Why do I claim that it's a good estimate of the cost of debt? Okay, so when you look on the website, when we talked about debt, and we looked at it on the website, you saw the yield to maturity on an array of different bonds. What is that yield to maturity reflecting about those bonds? Some of them were issued a long time ago, some of them were issued recently. Interest rates have gone up, interest rates have gone down, but what does the yield to maturity on a bond today reflect?
Firm's riskiness?
And
Rate of return?
yeah, it's the market's consensus about the riskiness and the rate of return on that bond. You can't argue with the market. The market is the market. So the yield to maturity on an outstanding bond essentially is telling you as managers if this is what investors, this is how they look at our bonds right now. And if we were going to float new bonds, that's probably about the rate that we would have to offer. And then finally, you can look to the debt markets as well. Look at similar kinds of organizations, what kinds of rates they're paying, and so on. For a not-for-profit healthcare organization, the cost of debt is the unadjusted interest rate. There's no tax considerations because they are tax exempt. However, for a for-profit or investor-owned organization, we have to take into account the cost of debt. So for example, we've got this Valley Clinic here, and we assume it has a 40% tax rate. If its cost of debt, before tax cost of debt is 10%, and we multiply the 10% times 1 minus the tax rate, and that gives us 6%. So that is the after-tax cost of debt. That is the cost of debt that we build into the corporate cost of capital. Because it's the 10% is the before tax. Essentially, 4% of the interest rate is being subsidized by Uncle Sam, but the fact that you're allowed to deduct that from your income taxes. So it's the after-tax cost of debt we use in the case of a for-profit or investor-owned organization. We will, in this course, and typically will ignore flotation costs for debt because they're typically small. That's not the case for equity, and we'll talk about that in a second. Okay, so debt is fairly straightforward because we can look to the debt markets, we can see exactly what our yield to maturity is on the bonds that we have right now. The more difficult component of the corporate cost of capital is the cost of equity. And that is particularly true as well for the not-for-profit sector. And if you've read the chapter, you can see it's much more complicated for both sectors, as it were. So let's start off with investor-owned. So the primary sources of equity capital to an investor-owned corporation is retained earnings, which is the profits they make over time, and they keep some of them. They may pay some of them out as dividends. They may invest in new projects with them, and they may keep some in the firm. So that is the source of equity, and that is called retained earnings. And then the other source, of course, is equity or common stock sales. So the cost of new common stock is basically the return that investors require on that stock. So there's an opportunity cost associated with retained earnings because if you don't invest it in projects in the firm, you could invest it somewhere else. So the retained earnings, essentially from a financial perspective, we regard retained earnings as the same cost of equity as the cost of new stock. So how do we estimate the cost of equity for an investor-owned organization? Well, there's three methods, two of which we've already discussed previously in the course, but we're going to quickly review right now. The CAPM, the discounted cash flow model, and a debt cost plus risk premium method. So the CAPM, the capital asset pricing model, as we talked about in Chapter 4, is an equilibrium model. It basically, what it does is it relates required rate of return to risk. And it assumes that the only risk that matters to investors is the volatility of returns over time. So the more volatile returns over time, the riskier the stock, the higher the required rate of return on equity. Because investors want to be compensated for the risk that they're assuming. So if you, as you recall, the security market line, the equation is the required rate of return on equity equal to the risk-free rate plus the required rate of return on the market minus the risk-free rate times beta. And keep in mind again that the return within the brackets, the required rate of return on the market minus risk-free rate, that is also called the market risk premium. I'm mentioning that now because in a few minutes we're going to talk about the risk premium, which is a different thing. The market risk premium in the CAPM is the term that's in those brackets, which is the difference between the required rate of return on the market and the risk-free rate. So where do we get all that data from? Well, RF is the rate of return on T-bonds, typically 20-year bonds, maybe 30-year bonds, but typically 20-year bonds. And you can get that from any website. Required rate of return on the market comes from brokerage house estimates, analysts. Betas come from proxy companies. And for example, Morningstar, which I attempted to show you a few minutes ago, they are the largest publishers of betas. They actually, you can go on their site and you can find not only betas for individual firms, but also averages for industries. So which is the weak link in the CAPM method?
RN.
Why do you say that?
Based on estimates and historical data, but that doesn't tell you what future rates.
Right. So if you were going to look at those, yes.
Could you restate what said? I didn't hear what you said.
I'm sorry?
We couldn't hear what she said.
Oh, she said required rate of return on the market. And so I'm trying to say, do you think there's another variable in here that might be more unpredictable than the required rate of return, estimated required return on the market?
Beta.
Right. Beta is by far the most volatile, the most error-prone estimate in the CAPM. Why is that? What does it assume?
Because you're estimating the beta for one company, and it's very, I mean, when you're estimating for a portfolio or for an index, it's less riskier, I guess, than when you're estimating just for one company.
That's true. Robbie.
You're estimating it based off of past returns, and so you're assuming that future returns are going to be the same as past returns.
That's right. So the way we come up with betas is we regress historical rates of return of the firm against historical rates of return of the market, and we use that as a proxy for the risk of the measure of the volatility of the company compared to the market. Well, when we use beta to calculate the required rate of return on the stock in the future, then we're assuming that the volatility in the past is the same as the volatility in the future. And that's a large assumption to make. Some actual betas from healthcare. What do you notice about a lot of those?
A lot of them are less risky than.
Most of them are less risky. Healthcare, generally speaking, is less risky than a lot of other industries. It's got a more predictable cash flow, more predictable earnings. Interesting, Tenet had a beta of 2.26 in this year. I think this is April 2010. They just come through a fairly major scandal and some big financial problems, which I think is why the beta jumped in that period of time. But generally speaking, even some of the biotechnology stocks like Amgen, fairly low risk kinds of firms. So how do we put this together then? So we get the risk-free rate from any financial website. We can get the required rate of return on the market from analyst estimates, brokerage house estimates, and the beta we can get from a variety of different industry sources. We put it all together, and we get 14.0%. So RPM here, as I just mentioned a minute ago, is the risk premium. It's the difference between the risk required rate of return on the market and the risk-free rate.